Going. Yeah, that looks like it's working. Fantastic. Kia ora, everyone. It's me, Georgia Hatchis. Welcome back to Digital Boost. Today we have a Q&A with Sam Harith, the comic accountant. And we've had Sam here a couple of times, and it's fantastic because Sam is an accountant and he's been really knowledgeable about a lot of topics. And if you go into our platform, you can find some of the other Q&As that we've done with Sam. And we also have done some workshops that have been really good. Today specifically is a topic that came out of our last Q&A. We were really curious about this thing. You kind of just dropped a bomb about like business loans. And I said, all right, we're going to draw that, extract it, make it its own event. Today we're talking about tips for getting your business loan approved. So Sam, we've been having a little bit on my end. It seems like there's a little internet back and forth. So hopefully I will still be here during this session. If not, Sam will be able to run the session. Drop your questions into the Q&A. I will be fielding that as long as I'm around. Welcome, Sam. Welcome back.
Hey, Georgia, thanks for having me here again. As always, it's a pleasure to be on Digital Boost, and it's a pleasure to be able to share my knowledge and experience with other small business owners out there. And yes, so you're absolutely right. This topic came about quite organically in our last session, where we were talking about how to, I think was it about planning for the worst in your business? I can't quite remember what it was. But yeah, I'm sure it's there on the Digital Boost repository. But yes, today we're going to talk a little bit about tips for getting your business loan approved. And this is something that we obviously deal a lot with. And every time our clients go and ask for a loan or try to get financing from the bank, they'll always ask for forecasts, and they'll often require a letter of approval from the client's accountant saying that, yes, this client can actually make money. Ta-da. Right.
Important, right? Like important information.
It's
Yeah.
supported. It's supported. But yes, so let's talk a little bit about some tips to getting your business loan approved. Okay, so what we're going to cover today is we're going to take a look at what banks look for when lending, all right, what a healthy business should look like, and how you can build bulletproof forecasts, right? Because ultimately, 9 times out of 10, the bank will ask for a cash flow forecast that shows your ability to service the loan. Okay. But of course, before we get any money from the bank, the first thing that we should be asking ourselves is, should you be borrowing? Right? Now, it's tempting to get finance, and it's very, very tempting to go out and use other people's money to grow your business, right? However, finance does come with a cost. Now, if you belong to the American School of investment and business ownership, you'll be taught that yes, that's the way to make the world go round. You know, that's how you take debt and you invest it in a property or an investment, and you get that investment to pay off your debt. I mean, in a world with perfect financial information where you know exactly what sort of return you're going to be getting, then yeah, that's great. Awesome. Cool. Do that. Then we'll all be like millionaires, right? But the reality is that when you take out a loan, no one takes out a loan with the intention of not paying it off. Well, that's unless you're I mean, because we're all ethical people here. You know, we're all good ethical people here, right? But at the same time, there is a lot of unexpected circumstances that can arise after you've taken up a loan, and then you may find that your projections don't hold up, and you may not be able to service that loan that you thought you could. All right. So let's take a look at some things to consider. Number one, what are you using the loan for? And this is a question that I always get my clients to ask themselves before they take out a loan, right? If you're taking out a loan, was it going to be used for? Okay, so generally speaking, most small businesses will use a loan for one of three things. Okay, so the first one being to cover your working capital expenses. So working capital basically means the amount of runway, the amount of cash runway that you need in between paying your staff members, paying for your supplies, and getting paid from your customers. Because often there's a bit of there might be a span of time between getting paid from your customers and the time that you actually need to pay up your staff and your suppliers. And often staff and suppliers need to be paid immediately, and your customers might take their own sweet time in paying you on time. It's especially true if you're like a service-based business or you run your business on an invoice basis, right? The second use of a loan is to basically purchase stock if you're a retail business. So if you're a retail business, you obviously need to purchase the stock before you actually make the sales, right? So you'll need financing in order to purchase that stock first. And unless your supplier is willing to extend you credit, you may need a short-term loan to cover the purchase of the stock. Right. And finally, one of the most common uses of business loans that I've seen in my experience is basically taking out a car loan or a vehicle loan. Yes, but generally speaking, these types of loans are very, very easy to get. They often don't undergo the same kind of rigor as, say, for example, a business loan or even a house loan. And I haven't really experienced clients asking me to provide details to the financier when they are buying a car on credit. I think part of the reason is because there's already an asset associated with a loan. And so therefore, if you can't pay off the loan, then the financiers just repossess the asset, i.e. the car itself. So I think they're a little bit more secure in that sense. But the bottom line is that think about what you're using the loan for. All right. If you need the loan, there's no point in getting money for the sake of getting money. All right. The next thing to think is, can you afford to pay it off? And especially right now, interest rates are the highest that they've ever been in the past 10 years. And interest rates are not looking, there isn't any indication they're going to be slowing down. There isn't really any indication that they're going to be coming down anytime soon. Depending on which economist that you follow, some economists are saying that, oh, yeah, it might come down at the end of the year. Yeah, hey, let's be optimistic. I'm a little bit more conservative than that, but that's probably because I'm an accountant. I'm not an economist, and accountants tend to be all doom and gloom. And what we will need to see first is a significant reduction in inflation before we can see the interest rates come down. And there tends to be like a 12-month lag between the two. All right. So once we have evidence that inflation is actually coming down, then we can safely predict that in about a year's time, interest rates will start to come down. So until then, we are still looking at an era of comparatively high interest rates for the next couple of years or so. Now, affording to pay it off means that you also need to be building into your predictions the likelihood of the interest rates going up if you're getting like a variable term loan, for example. And if you are locked into a fixed term rate, then, well, that actually just makes your forecasting a lot easier because then you know exactly how much it is that you're paying off, right? And if you're using the loan for business purposes, then you can also calculate whether the return that you make from selling the items that you bought you using a loan or the increased sales that you have with your new food truck that you borrowed money for, is that enough to actually pay off the loan and also generate a profit for you? Okay, because it's not good enough to just break even, right? We're in business to make a profit. Okay, we're not in business. This is not a hobby. This is life, right? And finally, think about if there are cheaper sources of finance. I mean, like I think it's all too often that business owners often default to loans as the first source of finance. They always go like, "Oh, cool, I want to do so and so in my business. It means that I need to go and talk to the banks and get a loan." You can always look for other sources of finance because remember that broadly speaking, there are two types of finance. You've got um, debt finance, which are loans, right? You've got equity finance, which is basically getting in partners into the business, getting people to buy shares in your business, and also putting more of your personal funds into the business, or getting your family or your friends to put funds to the business, or give you a loan at personal rates, which are lower than the market rates. Okay. Now, I would generally recommend loan financing as well. I wouldn't call it the last resort, but definitely do consider if you have other options. And it's always good to think about your options before you actually take a loan. Because remember that by the end of the day, if you take a loan, then especially if you're taking a loan with a bank or financial institution, just remember that if you fail to make the repayment, they actually do have the resources at their disposal to shut your little business down. All right. So just something to bear in mind. Okay. Okay. So with that out of the way, and if you have decided that, yeah, I'm gonna get a loan from the bank because that's my best option. All right. Let's talk a little more about what banks look for when lending. Okay. And so this generally applies to any type of loan that you as a small business owner will look for. And I speak from experience as a small business owner who has applied for a home loan, right? I've also dealt with clients applying for short-term business loans, and uh, dozens and dozens of clients who have applied for car loans as well, right? And you'll find that a lot of the tips that you get in this session will be especially useful if you are a self-employed individual looking to apply for a house loan. Actually, that is the most challenging thing to do for a self-employed individual, right? And I would say that it's actually harder for a self-employed individual slash business owner to get a home loan compared to someone who's salaried, right? Someone who's salaried, it's pretty easy. They just show their paycheck for the last 3 months, and the bank goes like, "Sweet, all right, here's your money, sir. Thank you very much." But with self-employed individuals, often there are more hoops for us to jump through before they give us the money. Okay.
Yeah, absolutely. I mean, I think that's a really important point to make because a lot of us are business owners and money is not consistent, right?
Money
Like
is
our
not
income
consistent.
is not
Yeah.
consistent and we can't show a consistent paycheck. So please, I'd love to know more. What's happening?
Yeah, sure. So key points that banks look for. The first one, obviously, is how much debt you have. Okay. Now, I remember trying to apply for a loan for my home loan back when I was this was back in 2020, right? And I had like borrowings from the IRD, the Small Business Cash Flow Loan. And yeah, the bank basically said to me like, "Oh, you owe the IRD $3,000," and it was just a small amount. And so yeah, I would recommend that you get rid of that or pay that off before you apply for a loan from us. It's fair to point out though that banks have relaxed their stance on the small business cash flow loan ever since then. And now based on what I have heard from my banking partners, is that they tell me that most banks will actually ignore any debt from the small business cash flow loan simply because um, it is it is a loan at such a really tiny interest rate of only 3 to 4%. Because you've got to remember that the loan came out during COVID. It was designed as a means of supporting small businesses. So the government actually marked it at an extremely low interest rate of about 3 to 4%, which back then wasn't actually that low, but it's really stupidly low now since the interest rates have gone up since then. So yeah, but just you can double check with your banker if you hold a small business cash flow loan from the IRD. There's a good chance that they won't treat it as a loan against your name. simply because it's an easy to pay off loan. Although in saying that, I have known a few businesses who are struggling to pay off their SBC loan, right? But it's also worth looking at whether you have any existing, say, car finance, if you have got existing mortgages from other banks, if you have got existing business loans. So generally speaking, the more debt that you owe to other parties, the less likely you are to get the loan. And I think that's just pretty obvious because the bank wants to know that in the event of a default, that they'll still get your money back from you. If you have other creditors who have a right to your funds as well, then they're less likely to get their money back in the event of a default. Right. And on that same point, the second thing that banks look for are assets that you can put up for security. Right. So assets that you can put up for security, obviously, if you own a home, that's your biggest collateral. If you own a vehicle, that also gets collateralized as well. I haven't come across a situation where you can put up your business shares as a collateral. I don't think banks do that. It's worth asking your bank officer, but I have not come across a situation where someone goes like, "Hey, I've got shares in my business worth X amount, so you can have that as collateral." Unless, of course, your business is publicly traded on the stock market. So, if you're Elon Musk and you've got $2 billion worth of shares, and you can always like borrow against that, because yeah, you don't need cash if you got that much shares, I guess. Right? Okay. Next is obviously your business profitability and your business cash flow. Now, profitability and cash flow are two different things. Profitability basically looks at your ability to generate money over a specific span of time. Cash flow actually looks at the cash going in and out of your business. Okay. So this also includes non-profit and loss items like drawings that you take from the business as the owner of the business. It also includes the actual timing of when your customers pay you. Because if you're looking at the profit and loss only looks at when you invoice your clients and when you receive your invoices from your suppliers, which may not necessarily match up with the actual timing of when the cash gets paid from your customers and the cash gets paid out to your suppliers, right? And more often than not, cash flow is more important than profitability, because you could theoretically create invoices for $100,000 and boom, you've got $100,000 worth of profit on the books. But then if your clients aren't paying off that $100,000, you still got zipped inside the bank account. You see? Yeah. And I'm not saying that you should go and create like 100 dummy customers to jack up your profits, but please don't do that. But I'm saying that the reason why cash flow is more important is because it's harder to manipulate cash flow than it is to manipulate profits, right? But please don't manipulate your profits, because that's wrong. It's unethical to do that. And please don't get your accountant to do that for you, because you're putting us in a really, really hard position if you do that.
Let's not manipulate anything.
Yeah, let's not do that.
Yeah.
Right.
Good point.
Okay. Right. Next is your net asset value, or your equity. So net asset value is your total assets minus your total liabilities. And naturally, the higher the figure, right, the higher your net asset value is, the more likely you are to get a loan, right? Because this shows to the banks that you are asset rich, and that if you can't make your repayments, then they can always go in and claim your assets. Okay. And finally, and which is probably the most important point, is your historical performance, 2 years or more. So in my experience, banks will only lend to you if you have been in business for at least 2 years or more. They need at least 2 years worth of financial performance before banks will go like, all right, cool, here's your money, right? And so this is actually really annoying, because sometimes you really, really need the money when you're starting up the business, right? And it's also really, really annoying as well, because you could be working in the business part-time for the first year and then really start to do it full-time in the second year. And then you could be halfway through the third year and you're making like twice as much as you were in the first 6 months of the previous year, but you can't really use the current results in order to help you out. I mean, banks will look at your past 2 years and your current year-to-date performance, right? And then it's really, really up to you and your accountant to be able to craft a convincing story that yes, your business is profitable, it is cash flow rich, and it's able to pay off the loans, right? And really, that's the sort of story that you want to be crafting for the banks. Okay, that's the sort of like image that you want to be presenting. So part of it is also, and obviously ensuring that your business is running well, but also another part of it is to ensure that you've got this convincing story that your business works, your business is in a position where it can pay off the loan, right?
So
So
just in that way, when we're talking about, and you're giving us the picture that way, where you're saying you have to prove that you can pay this money
yeah,
back. This is what we're
basically,
doing. Because
basically,
I
yeah.
was having a thought, I had a question earlier and in my head, and I don't know if it's like the American programming where you said, hey, let's say you've got a little bit of a loan, pay that off first. I mean, you couldn't say to the bank, "Hey, you know what? Let's consolidate that. I'm going to pay off this loan, that little loan with this bigger loan." And then that bank will be like, "Oh, yeah, okay." Because then you're not proving that you can pay off a loan. Is that right? You're getting a loan to pay off
Well,
another loan or
again, it depends. It
okay.
depends on what the bank's looking for, what the bank's looking after.
Yeah.
And you're absolutely right. It is quite common for banks to basically say, for example, you've got a credit card loan with Bank A, Bank B will happily give you their credit card, and then will happily loan you the money to pay off that credit card loan as long as you sign up with Bank B, right? But often it depends on the type of loan that you're looking for as well, and you'll find that banks are more likely to give out commercial retail loans because the interest rates that they can charge on them are stonkingly high.
Mm.
And but you might find that it's not necessarily the same case with home loans. And often trying to consolidate, trying to pay off a home loan from Bank A with Bank B will generally you'll generally incur penalties with Bank A, the bank that you're
Ah,
leaving. And it's not as easy in New Zealand as it is in America, I would imagine. It might be easier in America. I'm not so sure because I
I mean, I won't
yeah
even go into like what a mess
yeah
that is, but let's not
yeah
even think about it. But yeah.
yeah. But yes, but certainly not really the case here in Aotearoa.
Yeah.
So yeah, so yes, you do want to create this picture that you're a profitable business and you're really good at paying off your loans, right? So what is an ideal borrower? Or well, number one, you're solvent. Solvent means that you're not insolvent, you're not bankrupt, you're not currently under investigation or being wound up by any of your creditors. And yeah, you're not getting like you don't have a nasty letter from the IRD and that sort of thing. Okay. Number two, cash rich. All right, cash rich means that you've got a fat amount of cash sitting in your business that you can use to deploy. And how much is enough? Well, that really depends on the amount of loans that you're taking out. Right. Little to no debt. Okay, because this signals to the bank that they don't have any other competing creditors that they need to worry about when it comes to your money. A good credit history. So this helps if you've taken a loan before from the bank and then you've shown that you can actually pay off the loan, then they're more likely to loan you money. Highly profitable. Again, we're looking at profit margins of at least above 30%. So that means that your net profit margin, which is the little bit of profit that you make at the end, divided by the amount of sales that you make, is higher than 30%. And finally, lots of collateral. So collateral here usually means assets. So if your business owns a lot of property, owns cars and stuff like that, then that also shows the banks that, hey, I've actually got stuff I can sell off if shit hits the fan. Mhm. Okay, so next let's talk about what a healthy business looks like. And this is really, really simple. I mean, number one is positive cash flows, profitable. And the third most salient point is probably having a solid customer base. And this is easier to prove if you're a service-based business. You can always go to the banks and say, like, hey, look, I've got 100 clients that I service on a regular basis, and each client is worth $2,000 a year, for example. So, that's a guaranteed $200,000 worth of sales for me each year. Of course, this one's a little bit challenging if you're retail. If you're retail, you can still come in with proof of your transactions, the frequency of your transactions, and the amount of your sales figures, right? And if you are a SaaS, if you're an IT-based company selling software as a service, then often your customer base is more important than your cash flow of your profit or your profitability, because it shows that you've got the ability to scale in the future. And just as a side note, if you're a tech startup, you actually don't even have to worry about being profitable, because tech startups are often not profitable for the first 3, 5, even 10 years of their existence. Fun fact, did you know that Zero, last time I checked, was not profitable for the first 10 years of its existence? Mm-hmm.
I'm just sitting here with my mouth agape. Like, I don't
Yeah,
know if anyone can see me, but my mouth
yeah,
just dropped completely open. Okay.
yeah.
Okay,
It's part of the
Zero.
reason. It's part of the reason why Zero has been aggressively bumping up the prices this past year as well. Hmm. So Zero actually has not been profitable for the past 10 years. And yeah, because again, profitability is always a struggle for tech startups. But then you might ask the question, and how do these tech startups survive? Is because there are a surprising number of institutional investors out there who believe that tech startups will become profitable. So they just keep pumping money into them. It's just how it works. And so the share prices keeps going up, and because of the investor sentiment, because people keep buying it. And so as the share prices go up, then companies like Zero are able to leverage on the high share prices to borrow more from banks. And then banks will give them money because they own, so X amount of a lot of number of shares, right? And then the banks know that they can always cash out the shares as collateral, you see? So profitability becomes less important because Zero can say, we've got the product, we've got a superior product, we've got lots of customers, so therefore you should continue betting on us even though we're not profitable. Yeah, and that's usually how it works for bigger companies in the tech ecosystem. But I don't. I think it's fair to say that the most of our participants here today are probably not in that space, right? So remember that you still want to be profitable. You can't run a business at a loss and go to the banks and go like, yeah, 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 but I've got 100 customers and a superior product, and my shares are worth like $1,000 each. Yeah, because even though they're not publicly traded on the stock market, because that's based on my own estimates. Right? Yeah. So again, profitability, positive cash flows, solid customer base all go hand in hand. Okay. Especially the solid customer base because it shows the banks that you got a future, right? Yeah, the more customers that you have, the less likely your business is to fold tomorrow. If you only have, if you're the kind of business that has only 2 or 3 large clients, it's a lot more risky than a business that has like 100 smaller clients, right? Because it's less likely for your 100 smaller clients to all leave you the very next day. But your 3 large clients could very easily say, like, whoops, guess what? We're giving the contract to someone else. Okay? Right. Okay, so we've talked a lot about what banks look for, what a healthy business is. Now, the next topic that we're going to move into is actually looking at the nitty-gritty of building some bulletproof financial forecasts, right? Just talking about some general ideas of how you can do some forecasting on your own. Sharing you some tips and tricks that we accountants use to build out forecasts for our clients, right? Feel free to take these tips. do them yourself. If you are a spreadsheet whiz, by all means, you can do that. If you need an accountant to do that for you, well, I mean, we're always available. We're always looking for new clients, right? But before we move into this next section, are there any questions about getting your loan approved? Or maybe anyone wants to share stories about horror stories that they've had with the banks. Banks going like, no, we are evil. We're not going to give you money. Oh,
While we're waiting for people, if they want to type anything into the Q&A,
yeah,
yeah, please go for it. I wanted to say, before we got onto the call, you and I, Sam, were talking about how a lot of people didn't even try to apply for a loan because we feel that fear of rejection. That's so much of a thing that's deep in us. We're like, they're not going to give it to me anyway. But it's
yeah.
always worth trying,
It's
right?
always worth trying. And I think it's the same thing that I always tell my kids as well. I mean, the worst thing that anyone can say to you is no. Like if you want a job, go out and ask for it. The worst thing they can say is no. If you want a loan, you just go and ask for it. The worst thing they can say is no. If you want to go out on your date with a crush, right? Just ask them out. Like the worst thing they can say is no, right?
And the answer is already
And
no
yeah,
if you don't ask, right?
and the
If you don't
answer is
ask,
already
the
no if
answer
you
is
don't
no.
ask. Exactly, exactly. And look, I mean, I think in my life, as a business owner as well, I've had more people say no to me than yes. And that's just the reality of life. And eventually, the more no's that you get, the more it actually builds up your courage. It
Mm,
builds up your resilience, your emotional and mental resilience. And it teaches you that actually being said no to is not that bad because, for every no that you have in your back pocket, the chances of the chances of a yes increases.
mm. Yeah, that's right.
Yeah. Mhm.
I don't see any questions here, but please, if they come up as we're chatting, go right ahead. Don't feel like you're interrupting. This is what
All
we're
right.
here for.
All right, cool. So let's talk about building financial forecasts. And for those of you who've been following some of my earlier sessions, this is actually taken from the data and analytics presentation that I made a couple of years ago, right? But it still remains the same. Okay. So financial forecasts often start with the goal setting process. And here's where we get really, really technical. All right. So we're always going to start off with your current performance. So let's take a look at what your current performance is. Okay. And then we set goals based on your current performance. So let's take an example of this client who she runs a catering business and she was looking at getting a loan to apply to purchase a food truck, basically, right? And the bank said to her, before we give you the loan to purchase a food truck, we need to see some forecasts. Okay. so we so so her current setup is that she's a home-based caterer, right? She makes about $3,000 worth of sales each month and an extra maybe $2,000 from doing the markets twice a month. All right. So she makes about $1,000 sales at the markets. Okay. And so she says to me, hey Sam, if I've got this food truck, then I can do markets at least 10 times a month. I can go to the Hamilton markets, I can head up to Auckland, and I can even go down to Raglan for some of the markets down there. All right. So I can do more markets at the food truck. So that should increase my sales. And so we take a look at the current performance and then we set goals based on what will happen once you get the loan. Okay. Right. So again, I'm only giving this example from the point of view of capital expansion, getting out a loan to expand your business. So if you're getting out a loan to expand your business, you got to think about what your business will look like once you got that money, once you got that asset in your business. How does it grow your business? And so from there, we can set the goals. And the goals being that, all right, cool. Once we have the food van, we're going to look at sales increasing from $4,000 a month. It's going to increase up to $10,000 a month. Okay. And you've got to have the rationale, you've got to have the justification for how that sales increase happens. Okay. Because we're going to say that we can do another 7 more events each month with the food truck, and each event is valued at $1,000 worth of sales each. So therefore, that's $7,000 extra sales on top of the 3,000 that we're already making. So therefore, it's $10,000 that we're making each month for the next 12 months, for example. right? Okay, and then we outline the strategies to achieving those goals, right? So we say like, all right, we're gonna go to XYZ markets. Where also with the food truck, we can also rent out a council parking lot to sell our food in say in Hamilton City Council, because this client is based in Hamilton, right? And then it's a matter of having systems in place to monitor your performance and report the performance based on these forecasts. Okay, so
Before we move on, we do have a quick question here.
yeah.
So, hi, Sam. Any comments about the challenges of getting additional loan finance when you are developing new products and consequently profit from the existing product lines is being sucked into the new product development? I see. So the profit from the existing product lines is being sucked into the new product development. Any comments about those challenges?
Yeah, absolutely. You can actually you can set up your financial reporting system to report on the profit of each product line separately. So that way you can still show that product A is profitable, right? Even though all the proceeds from profit A are being subsumed by R&D costs for product B, all right?
Great. Yeah. Ian, let us know if that answers your question for you. Thanks, Sam.
Yep. Right. So, like I said, the goal setting process. So let's say, for example, you made 100K sales in the last financial year. You had profits of 50K, profit margin of 50%. You got 20K cash in the bank. So you can set your goals then. Okay, with the loan, I can increase my sales to 150. And so we're looking at monthly profits of 6K each month. Okay. With the new loan, we can outline new strategies. Okay. So the loan doesn't have to be limited to just buying a new van, but if you buy the new van, what else can you do to ensure that the new van will generate the return that you're looking for, right? New marketing, content strategies, new products, new offerings, new staff members, okay? So it's all really about thinking, what can you do with the money that you get to grow your business, right? And what's going to happen in the future when you have this money, right, to grow your business. And finally, the performance reports should be done continuously, all right, to track how your business performance relates to your business goals and to also benchmark it against your current performance. But I do acknowledge that this forecasting process is really useful if you're looking for a capital expansion loan. So like if you're taking a loan to expand your business, buy a new car, get a new piece of plant or equipment, or hire new staff into your business. What if you're just looking for a house loan? So if you're looking for a house loan, then your forecasting becomes a lot simpler, right? You just take a look at your current business performance, and really you're just looking at this first page here. You're looking at historical performance, and you're looking at projecting that forwards into the next year, assuming some very, very modest growth assumptions. So if you made 100K sales in the last financial year, then you can say like, okay, let's grow that by 20%. So I'm going to make 120K sales in the next year, all right? And my profit's also going to increase by 20% because I'm going to keep my costs down, for example, okay? And the idea is that you want to show the business that you can service a loan. And if you're looking at a home loan specifically, then the idea is that you want to show the business that you can take enough personal drawings from the business that you can pay off the home loan, because your home loan is still going to be in your personal name. Do not buy the house in your company's name. That is a profoundly stupid idea, simply because your company is probably going to be borrowing from other people as well. And then if you can't pay off their loans, then they can take your company to court and can take all your company's assets to court. And so your own home could potentially be liquidated by your company's creditors. And that's always a horrible position to be in.
I know someone that happened to, Sam. Yeah. So I can verify that this is a real thing here in Aotearoa, talking specifically.
Yes. No. And it's totally because they probably got bad advice They probably got bad advice. Maybe someone, their friend or their friend of a friend who's an accountant said like, "Hey man, did you know that if you bought it through your company, there are a lot of these tax efficiencies that you can make use of." And yes, and I do admit there are tax efficiencies that you can take advantage of if you're buying property through a company. But do not buy your own home through a company. Literally, the only other entity that you should be buying your own home in is a trust. It's either in your own
Mhm.
name or in the trust's name, right? And
Yeah.
trusts are really, really great. And this is why a lot of business owners use trusts to own their own home, is because trusts are, legally speaking, a really, really difficult entity to get anything out of. Like, I mean, I'm not a lawyer, and I can't really explain to you the legal intricacies of how that works. But to keep a long story short, it's really hard to get anything out of a trust, right? But don't put your own home in your company's name, especially if you're trading and borrowing money in the company's name as well. You
Yeah.
can, however, purchase investment properties using your company, and in some cases, it's actually more tax efficient entity to be buying up investment properties using your company instead of a trust, right? Especially now that trust tax rates have been revised up to 39%. But definitely your own home, don't buy it through your company. Yeah.
Great. Thank you.
Yeah. Right. And so yeah, again, by the end of the day, every business owner has a different reason for wanting to get a business loan, right? But in most of the cases that I've dealt with, where clients come to me saying that they need a forecast done, it's often to purchase a home. And yes, and banks will just ask you for these forecasts. Like I also got asked to do forecasts when I applied for my home loan as well, but it was pretty easy for me because I just, did like, yep, all right, cool, here it is. Yeah. But yeah, but I understand like for people from a non-financial background, it can be challenging. Forecasts can seem daunting, right? Especially if you're not familiar with spreadsheets, and it's difficult. It can be difficult to imagine how your business is going to grow like in the next 12 months, 24 months, simply because you are so caught up in the here and now that you don't even know if your assumptions are going to make sense. So to this end, it's actually really, really important to have your accountant or finance manager on board, because they'll be able to challenge your assumptions. So a lot of what I do is I challenge my clients' assumptions, and we come up with what you call believable assumptions that we bring forward to the bank. And part of the forecast as well is to also present these assumptions to the bank, and we basically tell the bank how we came to those figures, right? If I say that my client's going to be making twice as much next year than they are this year, then we come up with a story of how that happens. We come up with we are expecting to be able to hit all these other markets, and the customer base is going to triple because we're able to hit more markets than we were before, right? And every business is different. I think this is really, really important to emphasize that every business is different, and you can't exactly take a forecast template for one business and apply it to another business, right? A catering business will have vastly different assumptions to a legal firm, for example. And you do need to understand that you need to appreciate these differences between between the businesses. So again, which is why forecasting is not something that you would necessarily do on your own unless you come from a financial background. Mhm. Which is really a long-about way of saying that if you need someone to do your forecasts, you should really get in touch with an accountant. Yeah. Ideally us, but I mean, like if you've got an accountant that you like working with, you should talk to them. All right, cool. And so yeah, to sum it all up, really, getting your loan approved is possible. You just need to ensure that you have all your ducks in a row. Okay. On that same note, I have had clients who have only been in business for like 2 years and the profits of only about 30K each year. And they ask me, Sam, I want a house loan. I want to buy this $800,000 house in Ponsonby with a profit of like 30K a year. And I'm just like,
First of all,
so
you're like, where are you finding an $800,000 house in Ponsonby?
yeah. Oh, well, fine,
But
fine. This was
second of
this was
all,
two
no.
years ago. This was two
Yeah,
years
yeah,
ago.
yeah, yeah,
Yeah. Yeah, now it'd probably be like 1.2 million for like a two beddy.
yeah, yeah, yeah.
Yeah. Right. But yes, so again, you need to be realistic as well about the kind of loan that you can apply for, right? And obviously, smaller amounts are easier to apply for. And often the biggest hurdle for small business owners is that home loan, especially if you don't own any property, if you're like a first home buyer, right? And you're a small business owner, you're a first home buyer, and getting that first home loan can often be challenging, all right? And if you find yourself in this position, definitely reach out to your accountant. If you don't have accountants, or if you feel that your current accountant is unresponsive, feel free to reach out to us. 100%. Always looking for new clients. You can get in touch. Check out our website at thecomicaccountant.com. There's a contact us button right there. And you can definitely get in touch with us there. And me and the team will be more than happy to help you achieve your financial goals and ensure that you get your loan approved.
Thank
And
you, Sam.
hand over heart, I can say that we've got a 100% success rate with creating financial forecasts for our clients. We haven't had a single client who's been rejected for their loan application.
And that's really why I remember you
Mhm,
saying that, and that was
mhm.
really why I wanted to pull you in for this specific Q&A because I'm like, Sam's got some little tips and tricks here. But the thing that's great about you, Sam, is that you are conservative and you're not I don't mean it like you take conservative action as far as finances go, and you're not a cowboy with it. You're not just playing around with people's money. And the way that you deliver this information to us
Yeah.
is the whole way through. You're saying, let's be reasonable. Let's do it from a place of safety. So everything
Mhm.
feels really safe. Yes, you can, you know, do all the other crazy things if you think you're going to, well, okay, we won't get into manipulating stuff, but you can do things that put you in danger and put your business in danger and can put your livelihood in danger. But the
Yeah.
great thing about the sessions that we have with you is they're safe, that we're working conservatively here within our own finances and able to find a way forward that way.
Yeah.
So thank
Yeah.
you.
Thanks, Georgia. Like, yes, I really I'm very anti get rich quick schemes and that sort of thing. I do believe in the values of getting rich slowly. That's always been my philosophy.
Yeah.
Because yeah, a friend of mine who's also a business owner, he's once said to me that money that comes easily often gets spent very easily as well.
Hmm.
Whereas money that's built up over time often stays with you forever. Mm.
Yeah. Until you die,
And
and then
yeah,
you can't take it with you. But that's okay.
well, then you're supposed to leave it for your kids, right? And then
Yeah.
you create the intergenerational wealth transfer, right? And you
Oh,
further inequalities in society by hoarding all the wealth and sorry.
no, this is not a conversation for our Q&A. These are our private
Yeah, yeah, yeah.
conversations. Everyone, welcome to the private conversations Sam and I have. But if there are any other
Yeah.
questions in regards to the tips and tricks that we've gotten about getting your loan approved, pop them in here. Sam, thank you again, as always, for coming on
Hey,
and
always
sharing your
a
knowledge.
pleasure. Yeah, to come
You
on
know,
here. Yeah. Mhm.
I love how Sam, because Sam used to be a teacher, if you didn't know that. And so when you deliver your information, it is like we're being taught and we're being taught in a way that's we can absorb this information. So I
Yes,
appreciate you
that is
sharing.
true. Prior to starting my accounting firm, I was a lecturer in finance accounting for about 10 years. I did teach taught in a few places back in Malaysia, where I was from, and more recently, I taught at the University of Waikato. That's
Mm.
also where I got my PhD from as well. So, yeah.
Brilliant.
Mhm.
Oh, we do have a question. Let's see. Oh, it's just the thanks heaps. Fantastic. Thanks, Sharon.
Yeah.
Thank you everyone for showing up. I love seeing your faces here. I love seeing you for our Q&As. Come back on Thursday. We've got a workshop this week where we're going to be talking about your landing page and how to really tweak it so you get a nice high converting landing page. And that's going to be with Dave Hockley from Data Story. So if you haven't RSVP'd for that, RSVP for it, because if you can't make it, you will get the recording. And Sam, the recording of this is going to go up online on our platform. So if you want to watch it again, it'll be there. Thank you so much.
Hey, no problem.
Have a
Also,
wonderful day, everybody, and we'll see you soon. Matewa.
Matewa, kakitiano. Bye bye.
Bye.